So what is an IRA in the first place? I heard so many people my whole life basically saying that you need to invest in IRAs. And I know there's different types of IRAs. There's traditional IRA, there's Roth IRA. So in this video, I'm going to share exactly what these two things are, what the difference between them is, so that way you can make a decision on what you want to use to invest. And before we go into that, I just want to say I'm not a financial advisor. This content is for educational, really entertainment purposes only, and make your own decisions, and those decisions come with risk always. So that being said, disclaimer is out of the way. So I guess we can start off first by just sharing, about 401ks, because most of us know what that is, right? You work somewhere, and with a 401k, you can set up your 401k so that your employer takes money out of your paycheck before you even get it, and before, most importantly, before taxes are taken out of that, and they invest it into the markets for you. And based off of the amount of risk that when you set up your 401k, they invest it in different index funds that are either high risk, medium risk, low risk, and you can't pull that money out. You can, but you'll get a penalty, and you need to pull it out after a certain age to not get a penalty. So most of us are pretty aware of that, right? So an IRA, what it stands for is individual retirement account. Think of it like being able to set up your own 401k on your own without having to use an employer. And so this is really cool because I worked as a sales rep for about a year, and I was a 1099 contractor, meaning that I didn't have any taxes deducted from my income. I paid all those myself at the end of the year. I didn't have an employer that can set up a 401k for me. This is the same if you own your own business. You you might have 401k plans that your business has purchased for your employees, and then you can set one up for yourself. But if you don't have any W-2 employees and you're not a W-2 employee of your own business, then you can't really set up a 401k plan for yourself. And so that's where IRAs come in. And don't get me wrong, you can still have these even if you have a 401k. Actually, I would recommend it. But there's two different types of IRAs. So you're probably wondering, like, well, what do I get? A traditional or a Roth IRA? So I'm going to tell you the difference between both of those right now. And I was thinking about this because my partner, my girlfriend, she was asking me, like, what are the difference between these two things in the first place? And knowing that I'm going to school for accounting and I really like tax, and that's most likely the accounting that I'm going to go into, she knew that I would be able to answer these questions for her. So there's two different types of IRAs or IRAs, and the first one is called traditional. The second one is called a Roth IRA. And to explain this in the simplest way possible, and the way that I think about it is this. So with a Roth IRA, so one of them you pay taxes on before you contribute. The other one you pay taxes on when you are withdrawing and reaping the rewards, when you're like basically in retirement and you're pulling the money out. And so a Roth IRA, this one, you pay your taxes first. And so here's what I mean. When you contribute to a Roth IRA, you're, let's say, okay, you have a regular job, you're getting paid, and because you're getting your paycheck, that money has already been taxed. The tax has already been withheld from that. And then you can take some of that money and put it into a Roth IRA. So that means that income's already been taxed. And now you're going to contribute it into a Roth IRA, and then they're going to invest it into the market, into bonds, wherever you have your Roth IRA with. But when you withdraw it, all the gains that you get from that Roth IRA As long as you pull it out after you're 59, you have to do that 59 and a half for all these. They're set up to be retirement accounts. So you can pull it out as long as you're pulling it out without a penalty because you didn't try to pull it out early. With a Roth IRA, you will owe no tax on what you pull out. So let's say that you put $5,000 in a year into a Roth IRA, and you do that for 20 years. So that means that after 20 years, you're 59 and a half. So let's say you're 60 years old. Actually, let's make the numbers easy. I'm 40 right now. So let's say I started putting $5,000 into a Roth IRA every year until I'm 60. So for the next 20 years. If I do that, at the end of those 20 years, when I'm 60 years old, I would have put $100,000 into that Roth IRA. But there will be more money than that in there because that money is getting invested into the market. It's getting invested into ETFs, index funds, bonds. So let's say that over that 20 years, my money ends up turning into, and I'm just pulling a number out of thin air right here, just to make this simple. But let's say that it ends up being like $400,000, and most likely it'll probably be lower than that. But let's say that it's 400,000, and I'm 60 years old. I contributed 100, but there's 4 in there now, and I'm like, okay, I want to pull this money out. I pull it out, and I owe no tax. It's like here's your 400, here's your 400 grand. That's how a Roth IRA works. Now, traditional IRA, the process is the same. You still take your money that you get after a paycheck. So you've already paid taxes on it. And let's say that I'm putting 5,000, the same scenario, I'm putting $5,000 a year into a Roth IRA for the next 20 years. Well, let's say that I put 5,000 in this year, and then when I'm doing my taxes next year, I get a tax write-off for $5,000. I get to say, hey, I contributed to a standard IRA, and I contributed $5,000. Well, I get a tax credit for that. So this is how you end up putting money in without paying tax on it. But here's the caveat. I end up putting 100 grand in there for 20 years, and then there's 400K in there after 20 years. I go to pull that out, and then the government, the IRS, says, okay, you pulled out 400 grand, you put in 100, so that means you made $300,000 in gains on this, and now you have to pay a capital gains tax on that $300,000, and so you'll owe that tax. So you won't end up getting that full 400 grand. So what is the best one to choose? I would say I can't really speak for you because I don't know your whole situation and I'm not your financial advisor. You should have one and you should ask them, or at the bare minimum, once you're getting into investments, have a CPA that specializes in tax, um, help make this decision with you. So I'll share some of my situation, right? So I'm a veteran. I was in the Air Force for almost 8 years. And because of that, the Department of Veterans Affairs is paying me to go to school. They're paying for my school. This is how I'm getting trained and going to school for accounting. They're paying for all my classes. They also pay me a living stipend. So I get a paycheck every month from the VA because I'm enrolled in school full time. And that paycheck is non-taxable, meaning I don't get taxed on that. And, the IRS knows about it because I put it on my taxes that this is VA income and it's non-taxable. They know that I get paid it, but it's not taxable income. Because this income isn't taxable, which IRA should I choose? Should I choose to put my money into a standard IRA or a Roth IRA? Well, if I chose to put this income that's already tax-free into a standard IRA, well, that means that, yeah, I would get a tax credit for putting it in there. But I don't need a tax credit because this income is already tax-free. And I would pay tax on my gains when I pull it out when I retire. But if I put it into a Roth IRA, well, this income that I'm already making is tax-free. So I can take this tax-free money, put it into a Roth IRA, let it grow over the next 20 years, and then when I pull it out, also not pay tax on it. Not pay tax on the gains that I made off of the tax-free income. So for me, specifically, it makes the most sense to max out my Roth IRA every year, to max it out with that. And if I was somebody in a different position, like let's say that I was already working as an accountant, making, uh, let's say $100,000 a year. Actually, let's say that I was on the verge of, I was in a high tax bracket and I was really close to being in a lower tax bracket, but I just make just a little bit over. So I'm in a higher tax bracket, which means I'm paying a higher percentage in taxes. Well, if that's the case, then it makes total sense for me to do a standard IRA because I'm going to get those tax deductions, those tax credits, and they could lower me into a lower tax bracket because it's reducing my taxable income, which means that I end up paying less in tax right now. And the whole thing is like, well, once you retire, maybe your income drops because you're just living off your retirement, and then that puts you into a lower tax bracket. And so when you pull this money out of your IRA, you're already in a lower tax bracket. The amount that you're paying on your long-term capital gains is going to be lower. Uh, so, but here's my advice if you don't have either or I can't say it's advice because this is not advice, right? This is just my opinion. Um, if you're in a lower tax bracket already, like I am, my income is non-taxable at the moment. So it means I'm in like the lowest of tax brackets, right? So, I mean, of course, except for the income that I make from YouTube and like business stuff, and that stuff's taxable, but the main income from the VA isn't, right? So, my tax bracket is lower, and it makes sense for me to max out my Roth IRA while I'm in a lower tax bracket. I don't need to lower my tax bracket right now. And if you are in a higher tax bracket, you can contribute to both. Contribute to both. You're never going to be, this is my opinion, but I'm never going to be like upset with myself that I over invested for retirement. It's not going to be the case. And if you're wondering how you could even start an IRA, you can do it from any brokerage account. Like you can sign up for like Fidelity or Charles Schwab or anything like that, just online, and you can set up your own IRA. Like I actually found I set up a new IRA just today. So it's making me think of this. I set up a Roth IRA, of course, and I did it through Robinhood, through the app. And it was really cool because they had a matching on there. No, this is not a paid sponsorship for Robinhood or anything like that. I'm just telling you what I did. I signed up for it through there, and I saw that they contribute $3, or they contribute 3% to my IRA. Whatever I contribute, they also add 3%. So um, I put in $500 into my Roth IRA, and what did they add? They added 15, and then I took that $515 and put it into the different stocks and ETFs and bonds that make sense for me. And they make it easy to figure that stuff out too. So you don't have to think if you're not like a savvy investor. or who has experience. Um, I guess the most important thing is, even if you feel like you don't know this stuff, you can always just download an app like that, like Robinhood, and just try it. But also know that whatever you put in there, plan for it to just be gone out of your life. That's the best thing to do, because if you withdraw your investments and your gains early, there's a pretty hefty penalty. And the penalty is, see, I have it written down so I don't mess it up for you guys. The penalty is uh, automatic 10% penalty when you withdraw, plus you have to pay regular income tax on it. So all this stuff is tax advantaged. Regular income tax is the highest tax that you can pay. It's like the tax that you get for working a W-2 job. So if you withdraw your stuff early from this, it dips down to 90% already immediately, and you pay the highest tax that you can possibly pay. So what you put into these, plan to leave it there until your retirement age, until you're at least 59 and a half. That's the rule. And wherever you set it up, like when I set it up with Robinhood, they have more stipulations on there. So make sure you read the fine print. Robinhood said, yeah, you'll get this penalty, and you have to leave it in. You have to meet two conditions with them. It has to be in there for 5 years, and you have to be 59 and a half. So even if you start putting stuff in there and you're 58 years old, you still have to leave it in there for 5 years to not have a penalty on it. So looking at my little paper, making sure there's nothing that I missed here. So yeah, that's basically what an IRA is. It's an individual retirement account. Having one of these is different than just investing in stocks that you like. Uh, I think anybody with a balanced portfolio is going to have, like for me, I have a high yield savings account that's gaining interest. I have a Roth IRA now. I also have stocks. I have some bonds, some index funds, and if you're looking, maybe you're looking to invest in individual stocks and you don't want to just, uh, or you already have an IRA and you're just watching this because you like to geek out about this stuff like me, um, and you're looking for what are some good stock picks like right now. I made a video about that just the other day. I'll have it linked up here on the side. You can check that out in this video. It's just my opinion, but it's what I think is the prime opportunity that's happening right now because of current market conditions. Check that out. And if you like this video, make sure you subscribe, like the video, because it just helps. See you guys.